Good morning, everyone, and thank you for joining us for our fifth K3 Hub CPD webinar of 2025. And it is all about understanding the accounting requirements of LLPs. This is my second substitute appearance of the season. I'm Richard Easterby. I'm a director in Quantuma's Birmingham office, and Quantuma is part of the wider K3 Capital Group. So I'm a licensed insolvency practitioner, and I head up the restructuring offering in Quantuma's Birmingham office. I lead on many assignments locally and also nationally, and those assignments have either a transactional element, a contentious element, or both. In addition to restructuring and insolvency, the K3 Capital Group offers a wide range of niche advisory services, including corporate finance, forensic accounting, R&D tax credits, transactional tax, and marketing services for professional services firms. Just by way of background, this webinar is part of the K3 Hub training and events program. So in 2021, we launched the K3 Hub, which is a member network for professional advisors, and today we have over 3,000 members. Before I hand over to today's speaker, I wanted to touch briefly upon where we see most activity in Quantuma's restructuring and insolvency team when it comes to LLPs. We have a specialist team that advises professional services firms, particularly law firms, and many of those firms are, of course, LLPs, and we advise them when they are facing financial distress. The reasons for professional services firms facing difficulties are many and varied, but there are a couple of topics that come up frequently. The first is in relation to the major assets of professional services firms, which are usually work in progress and debtors, and the policies governing their valuation. And those policies can change dramatically from firm to firm, which results in some firms being very bullish about recovery prospects and others being very prudent. The policy chosen is heavily influenced by the auditors if a firm is large enough, and that can naturally have a large impact on a firm's balance sheet, but also its forecasting. And the optimism around converting work in progress to bills and bills to cash can quickly become problematic when cash becomes tight, and when perhaps bad news hasn't been foreseen or appropriately allowed for. The second issue is that we see is that when firms are feeling the squeeze, there can be limited costs that are capable of being cut. The largest costs are often property or staff, and cutting them is often difficult or very costly. Also, increasingly, there's a very large spend on IT these days. And in that area, costs can build up dramatically, whereas systems are not always implemented effectively and efficiently. At the moment, we're not seeing a huge volume of formal law firm insolvencies in particular, but you may have seen there's plenty of news at the moment regarding staff cuts being made by some of the larger law firms, and there isn't as much M&A activity as there has been, nor are there many firms listing. And so it'll be interesting to see whether this is an indication of troubled times ahead for the legal sector, or whether things begin to pick up. Right, well, on to today's session. I'm delighted to welcome David Potts as our speaker today. David is a chartered accountant with over 30 years of experience. He set up his training business in 1998, and since then has been delivering training programs for accountancy practices and legal practices, investment banks, owner-managed businesses, and international PLCs. He also has experience preparing students for their professional examinations for ICAW, ACCA, and CIMA. Just a bit of housekeeping to run through before I hand over to David. We are recording today's session, and the recording will be available on the K3 Hub and Quantuma websites next week. You'll also find a list of upcoming events on there. You'll see the Q&A function that is open, so please do feel free to ask questions as we go along, but it is our preference, if you can, to use the Q&A function for those questions. but David will also be happy to take questions via the chat. We are expecting to receive lots of questions today, and so invariably we won't be able to cover them all. So if you don't get round to having your question answered, we will ask David to respond separately via email after the webinar. A copy of the slides and accompanying notes will be in the chat at the beginning of the session, and then periodically another copy will be added for any latecomers, although I'm sure we won't have any of those. It is a long session today, 3 hours, and so depending on how things are getting along, there may be a couple of 1 or 2 comfort breaks of around 10 minutes each. The next CPD webinar is on the subject of inheritance tax, which is very topical. It seems like every day there is a story about inheritance tax in either the financial or national press. And that webinar is going to take place in a fortnight's time. You can go to the K3 Hub website or the Quantuma website for further details and to register if you haven't already done so. So, thanks very much for your time today. I hope you enjoyed the session. If you want to reach out to me or any of my Quantuma colleagues, we'd be happy to have a chat. My details will shortly be posted in the chat box if they haven't already. Please do enjoy the webinar. I'm sure you will. Have a great weekend. And David, over to you.
Thank you, Richard. Thank you for that introduction. It's really useful and helpful for my part as well, because as an accountant, my background, my focus is in all the kind of various training I do on financial reporting, trying to make sure that the accounts are being properly prepared. One of the kind of basics of good corporate governance, that you're dealing with information which has been properly prepared, whether or not it has been audited, what you can expect to see within that. And with some of the issues which were just raised there around things like valuations, things like the judgments which go into that, what is actually the acceptable range? One of the other kind of personal features of accounting that I do feel is there's always the danger of being lost somewhat, is the fact that any financial report has to be fundamentally supported by good core accounting records, a good clean set of records which do, at the very minimum, balance and add up to the penny, can be supported to the various kind of control accounts and reconciliations, whether that's to the bank, to debtors listings, whatever, those fundamentals, so that everything that is then reported from that at least is based on kind of good, valid information. So as was mentioned, we've got a 3-hour session today. We will be taking a couple of breaks. What I will do as we go through is cover everything from the basic fundamentals of LLPs, their legal structure, what are the key elements within that, what would normally then go into their annual report, looking at everything from the kind of smallest through to the kind of issues for the larger, as was just mentioned, major law firms, major accountancy firms. And then there will be some focus on what are some of the more kind of judgmental issues to get to grips with. As was just mentioned, if you do have any questions as we go through, please do feel free to put them in the Q&A. It's easier if they're all in that one place, because I got a better chance of finding them. I will try and go through some of them at the end. But as was just mentioned, if I can't deal with all of them, some of them, I think, as I've seen already, are on fairly kind of specific tax points around the taxation of the profits, the gains, the losses from an LLP, which I will be covering to an extent as best I can. But my focus is predominantly on the kind of accounting implications around that. I did have one initial question for you all, and this was in the form of a poll question. So I don't know if we could just share the first poll question for everybody to have a quick look at. And it is really just to get a sense of all of you, just where are you currently when it comes to LLP? So then if you could just want to have a quick look at this one, and would you say your current knowledge, understanding is very good? You just want to know what are the latest kind of key developments and issues? Would you say it's quite good, but, as always, an update, a refresher would be useful? Would you actually classify yourself as, not that really good at all? You've heard of it, you're aware of them, not much beyond that, or are you an absolute beginner? So if you do want to just click on which one best reflects your views, that would be very useful for me to see at the moment. I'll just give it a minute or so while you're having to think about that. Okay, now that is very useful, and it does hopefully then mean that what I've prepared for you this morning in terms of the slides and the materials and the content is relevant, because obviously for those who are ticking in the absolute beginner box, there is no real assumed knowledge around this. And for those who have got some fairly decent awareness already, there will be an update on what are the kind of current key issues around this. There's a couple other sets of polls that we'll be going through. I've got a few practical examples as we go through, thank you. And also in the separate handout, which is the Word document, there are some more full worked examples in terms of what these accounts look like when we put them all together. So in terms of some of the basics, obviously it was just kind of alluded to there initially. When LLPs were created 10, 15 years or so back, they were created with a lot of demand from professional services firms, lawyers and accountants, who said that, you know, what we really want is this kind of modern hybrid of being able to operate as a partnership with all the strengths that that gives us. Partnerships, there is that ability for easier succession. People can leave and join as members a lot more easily and more straightforward than with a limited company, where reorganizing the shares, even though it's not as controlled as it used to be, is still something which poses a bit of a problem often. With a partnership, revolving door from 1 year to the next, it's a lot more straightforward. But what we really want is the protections of limited liability. So we'd like to have that protection from a limited company, so we don't spend our whole lives worrying that there might be some kind of claim and the professional indemnity doesn't cover it, and then they're attacking our personal assets. And if we've put them all in the name of our family, our spouse, whether there could be some issues then around, you know, family law matters and divorce matters, and are we really comfortable doing that? And that is where the limited liability partnership filled that space to provide that hybrid in the gap. Since then, though, it has also been seen as a very attractive business model in other situations. At the top end, a lot of the kind of investment funds markets, private equity funds, and anything of that similar nature, where you've got a group of investors who are going to be providing money, which will be invested in a number of projects. Well, the ideal structure for that was seen to be a limited liability partnership, where you could almost set up this LLP for a particular activity. And it does, again, allow people to join, increase their contributions, reduce them as well. At a different level as well, they're also a very useful model for any kind of single project development. And I have heard a lot of people seeing them being used in property development. So where you've got the property developer, you've got the construction company, you've got the landowner, and they can all take relative shares, and those can all be predetermined in the piece. So that kind of hybrid model really sits at the heart of how we put the accounts together. It is a Companies Act corporate entity, so therefore it is subject to all the kind of normal expectations and requirements from the Companies Act. So you do have to prepare your accounts for filing at Companies House, and there are the various exemptions that would normally be available for small and medium-sized entities, which are very generous at the moment, but there is this warning that that is not going to continue. Like all other companies in the UK, you've got a choice of accounting, and you can either use UK accounting, UKGAAP, our standards, or you can use IFRS. Now, I don't very commonly see the use of IFRS, but it is there as an option. And then obviously the other big win is, unless you've had to give some kind of personal guarantee, which is always a possibility, the partner's liability will be limited. Now, the partnership elements, this is the fundamental. The profits as calculated on the partnership, the LLP, are not taxable in the hands of the LLP. So LLPs do not pay tax on their profits. Those profits need to be allocated across the partners, who are called the members, and it is those individual members who will then pay tax on their profit share. Now, it'll be then the standard kind of process. You work out the accounting profits. You then work out what those profits will be for tax. But this is where the difference comes in, because if the person receiving the profits is an individual, you would work out what is their profit share in accordance with income tax rules. And that will then go on their personal income tax return, their share of the profits, their share of the losses. And that would be subject to the normal kind of income tax computation. If it is a company who is receiving a share of the profits, and the share of the profits would be dependent on what is the profit sharing arrangement which is in place for that particular year. And if it is a company that is receiving them, they will calculate their taxable profits for their corporation tax return in accordance with corporation tax rules and requirements. So whether it is considered income tax, whether it is considered a capital gain, if it is an individual, or whether it is considered a capital gain by the company, subject to those special rules. Now, there is one other point I've made about taxation, which a friend of mine who lectures all the time on tax was warning his groups around. And he was warning them about the rules on disguised remuneration and saying, just be very, very careful, because if you've got what we used to call a salaried partner, and you've got someone who is just going to get a regular fixed profit share every year without any real variation, without any real exposure to the volatility of the business, to actually argue that that is a profit share in a business in which they have an ownership stake is actually not true. They're basically just getting a fixed salary. So that is why it would then fall into the PAYE system. And even though it is a profit share, it would then have to be taxed under the PAYE system in the LLP. And that would then lead to company national insurance being chargeable on it. Now, the comment that my friend made was he couldn't understand why this didn't apply to partnerships. He said, it just seems unfair because that wouldn't happen if it was a partnership. Why if it's an LLP? And then I kind of pointed out to him, well, the clue's in the name. With an LLP, you have limited liability. So therefore, if you are getting a fixed profit share, there is no financial risk to you at all. If the whole thing, as Richard was mentioning, if the whole thing fails, you can walk away, get a job somewhere else, no comeback, no recourse. If you're a partner in a classic old partnership, if it fails, there could be recourse to you personally from the creditors. So that is why in partnerships, there is always that kind of equity stake, which is why this doesn't apply. But you've got to be careful because obviously on the individual partners' tax returns, you've got to be careful that it is not seen as just a fixed reward and therefore they are effectively employees not earning self-employed income. A few other basics: they don't issue shares and members may be asked to contribute capital, but they don't have to. And I have been asked the question from someone recently, do members have to put in capital? No. They might, when they set it up, decide that they're going to, as I did with my LLP, which is how I operate, I'm going to give it my laptop, put a value on my laptop, and that was the sum total of the starting capital. Absolutely fine. Now, in terms of the accounts, there is an example on this in your notes, but it is again a hybrid. because what we effectively do with LLP accounting is take as our starting point what would be the normal approach to partnership accounts. So way before we had LLPs, when you were doing the accounts for partnerships, and I trained in a small accountancy practice, 6 partners, and we had the classic general practice client portfolio. We had everything from one PLC, a few financial services businesses, a fair number of charities, the local church, and quite a few partnerships. So you got exposed to everything. So you would see the fact that, yeah, in the partnership, they would be producing a profit and loss account, but it would stop when you got to profit available for the partners. And when what you would do is you would prepare an appropriation account, which would show how that profit was going to be allocated, appropriated to the individual partners. Now, if there was only a few partners, 2 or 3, you might show that all in that one note. If there was hundreds of partners, you would just show the summary, how much you're getting, a fixed share of profit, what are the various different mechanisms which are being used? Do they get interest on their capital? Do they get charged interest if they make any drawings? All of these various adjustments. And then what we would do is prepare the balance sheet. But again, the same approach would apply in the balance sheet. When you got to the net assets, this would be the net assets available to the partners. And then those partners' elements of those net assets, without very much thought, would just be divided between long-term capital that they've contributed, if there is any, and then just short-term contributions to the partnership, which would normally be any profit shares allocated to them, less what they've taken in drawings. And that could be either a positive or negative balance. You know, if the partner was very well disciplined and only took a certain level of drawings, they might have never drawn out in cash all their profits. But obviously the opposite could often apply. But that would just be again shown at the bottom of the balance sheet. How is that money being allocated? Now, I'll come back to that point later. There is an example in your notes using a fictional partnership. But that point is absolutely significant. Now, just a few things about the legals. And here you have got to be careful depending on when you get involved. An LLP, obviously, as I've mentioned, is a legal entity and it is kind of regulated by company law. As such, the basic structure is set out in company law. But unlike with a limited company, where you have then all the details which are kind of preset in terms of the articles of association, the members, the memorandum, the objectives, the protections for minorities, shareholders, none of that exists when it comes to LLPs. These really have been kept just to the very basics. So what that means is all the agreements between the LLP and its members and the members amongst themselves, you are starting with a clean sheet of paper. Now, obviously, in some LLPs, they don't really put anything ever down on that paper. You know, I know a lot of kind of very simple owner-managed LLPs. They'll just pay the fee to Companies House, set up and start running with nothing else being set down. Obviously, what some more established ones will do might get a lawyer to draft up an LLP agreement, which will cover all of those various issues in terms of holiday, capital, profit sharing arrangements. And, you know, they both serve or both pose different problems to an extent. If there is no agreement at all, then you've got to make sure that there isn't going to be any misunderstandings or any disputes. There is this kind of default position in the absence of agreement. Profits are shared equally. But beyond that, it is probably worth, if you're getting involved advising, as soon as possible, set down some of the more fundamentals. What are your expectations regarding holidays, working hours? How are the accounts going to be prepared on those kind of judgmental matters that were just being mentioned for key items in the accounts? What policies are we actually going to use so that we can agree amongst ourselves what is appropriate? If you have got a full detailed legal agreement, we are still operating in a UKGAAP environment, which means that we need to focus on the commercial substance, not the legal form. So you will often have to go through with a kind of quite strict edit function and just think, well, okay, out of all of that lot, what are actually the kind of significant elements in substance here? And we do have this quite often in accounting now, where, you know, it's the lack of real clear detail which can then lead to problems, disputes later. Now, as a very simple legal framework, the reporting requirements to Companies House are fairly limited. The only other thing which is specified is that within the LLP membership, although all the members are considered to be equal, you do need to specify certain members to Companies House who are designated. And that means they are the kind of more visible representatives who will generally serve as the kind of company secretary. They are the kind of identified officer who is the kind of primary point of contact with Companies House. Now, in my LLP, there's only the two of us, which is actually my wife and I, so I'm the only designated member. I did see a law firm, an example we're going to come back to later, and every single partner, every single member was a designated member of the LLP. Now, just one final key kind of surround issue to bear in mind around this is, as a UK companies entity, if they are, as the vast majority do, if they are going to be following UKGAAP, then there is a separate SORP which will set out how they are expected to vary what would be the normal accounting requirements because they are an LLP. And as with all of the statements of recommended practice, as of all the SORPs, every time there is a change in UKGAAP, then the relevant SORP guidance has to be updated. And all it's really trying to do is make sure that guidance is given how to comply with the normal accounting and not do anything which is unacceptably inconsistent. Now, the latest version of the SORP, which should be followed, applied from last year, 2024, that was more a kind of housekeeping terminology change. It wasn't as substantial. It was really just trying to clarify some of the more problematic areas. And I'll pick up on probably the most problematic of the problematic probably after your first short break. The choice to use IFRS, I'll mention very, very briefly. If you do decide to use IFRS, you may follow the SORP for guidance, but you don't have to. The SORP is only a requirement if you are following UKGAAP. Now, there will be a new version of the SORP expected, but that will not be coming through until next year. But in all cases, the SORP has to be based on UKGAAP. Now, I did just check before we started whether you've had any kind of recent training provided through K3 on UKGAAP. That doesn't seem to be the case. So just to raise some of the critical issues relating to LLPs, what I've got for you are just a few poll questions again. And again, don't worry if you don't know the answer to any of these. If you could just put up the second bunch of poll questions, please. If you just want to have a scroll down and have a go at these, we're not going to share the answers just yet. I want you to spend just a minute or so seeing if you are able to address any of these issues. While you're just spending a little while looking at that, what I will do is just see anything has come through of relevance. Okay, so just quickly, just to recap on these questions. First one, what primary statements must a small company currently file put on the public record at Companies House? Which one of those four? Second question, when does the new on-balance sheet treatment of leasing or leases become compulsory under FRS 102, the most recent changes, which came out last year, which is one of the most hottest of hot topics? And I've given you again 3 choices there. What is the main difference between goodwill and all other intangible assets under UKGAAP, which is really maybe something more of an issue around professional services firms, and particularly maybe with the kind of tax treatment? When can you use merger accounting under UKGAAP? And then finally, which of the following is an equity interest under UKGAAP? Okay, on the basis that with most of these, you probably will either know or you won't know what the answer is, if we could now share the results, please. Okay, so which of the primary statements must you file? And it is still the case if you are a small company. Well done to the 86% of you who went for this option. You have to file the balance sheet. And out of all of the primary statements, that is the only one that needs to go on the public record. You don't have to file your profit and loss account, and you don't have to file any of the other normal primary statements which are required by accounting standards rather than company law. And that would include the statement of other comprehensive income and the statement of changes in equity. The statement which shows what has happened from one balance sheet to the next. So all of the kind of profits, gains, losses currently can be kept out of the public domain. Now, there was the proposal from the last government that all of that was going to change. All of that is going to disappear, and companies should all have to file their profit and loss account. They should have to file their full accounts. That at the moment is the intention within the legislation. It has not yet been finalised. It is still to be confirmed, but there is that kind of threat hanging over you that if you were going to go for a limited liability model, whether it's a limited company or an LLP, it could well be the case a couple of years down the line, you have to tell the world how much you're earning, which obviously for many people is not going to be a comfortable position to be in. When will the new on-balance sheet treatment of leasing, now this could take us down a whole kind of separate area of training, but essentially where we're going to be moving in the UK for all entities other than micro entities, and for all entities, LLPs and limited companies, you are going to have to start, as we've been doing under international standards, for all lease agreements where you are leasing someone else's assets and the lease agreement is going to run for more than a year, and it is material. If all you're leasing is a little sum up payment device, who cares? But if you're leasing a car, if you're leasing a building, Richard mentioned again about the significance of property costs to an LLP, which is a professional partnership. Well, any of their lease agreements or anything which is in the nature of a lease agreement, that will have to be reported on their balance sheet as a right of use asset with a matching liability. And that is going to come in from the 1st of January 2026. So again, most of you got the right answer on that, but it is with no restatement of comparatives. So the right answer to 2 was the third one, and it is 2026 with no restatement. So there will be this big bang change. 2025, nothing on the balance sheet. 2026, the leases will be on the balance sheet and they will now be charged depreciation. And the lease liability will be on the balance sheet, and you will have to calculate what is the interest which is implicit in that lease agreement. And that will go through the profit and loss account as well. And HMRC have made it clear that whatever is going through P&L will be tax deductible. And that means rather than just charging your rental straight line, you will have, as is always the case with lease agreements, more money going through in the earlier years, more being deducted in P&L than in the later years. Now, the reason why that is worth mentioning with particularly a professional partnership firm is if the partnership is changing, if people are joining and leaving, which is maybe fairly common, that will change the profit sharing just for that reason. The profits between 2025 and 2026 will change just because of the leasing. Having that discussion sooner rather than later, deciding what they want to do about it. Does there have to be some kind of allocation to equalize for those people who are going to get the hit with the bigger deduction in their year as being a partner? The sooner you deal with it, the better. For the third question, what is the difference between goodwill and all other intangible assets? Well, yeah, I mean, I would accept under IFRS, goodwill does not have to be amortized, but under UKGAAP, it does. The second option, though, goodwill is inseparable from the host entity, is correct. And I would say that is the key difference. And what we've been trying to move to is the fact that just calling all of your intangible wealth goodwill is oversimplistic. And actually, if you're buying a services business, you should look at things like the customer list, the databases, the intellectual property, the precedents, because those are not goodwill. Those are separate types of commercial assets. Now, the significance is that, well, under UKGAAP, they all have to be amortized, goodwill and all other separables. But under UKGAAP, intangible assets can be revalued. So you have got that opportunity to revalue them. And also different types of intangible, you never know, might be subject to tax relief if you are claiming deductions. Final couple of questions fairly quickly. When can you use merger accounting under UKGAAP? Well, under IFRS, it is not mentioned. It just doesn't exist as a concept at all. But under UKGAAP, it does exist. And this is where there is any kind of reorganization, reconstruction, business combination in any shape or form where there is no change in the controlling parties. So well done for the 44 of you had a go at that one. The answer was what the 25% of you went for, where there is no change in the controlling parties. Now, the legislation on this is absolutely strict, that there should be no change at all. So if one equity member left, it would not be considered a merger. If one equity member had their rights changed, it would not be a merger. However, the view of the ICAEW is that that is overly strict. And actually, what we should recognise is that if the essence is that there is an extension of an existing business into a new business model, then you should be able to use merger accounting. The LLP SORP does deal with those evolutionary transactions where an existing partnership converts to an LLP, where an existing limited company converts to an LLP. So there is guidance on the accounting which is needed around that. And then finally, I've raised what is one of the biggest challenging topics that many consider in an LLP, which is how does the members' capital have to be presented if we're going to be consistent to what we do with limited companies. And with limited companies, we do distinguish between what is a liability, top half of the balance sheet, and what is equity. And what we have for limited company is a very limited, restrictive definition of what we think of as equity. Equity is anything, a contractual interest, which is in the residual. So which of the following would be equity? Preference shares redeemable at the request of shareholders? No. They can demand their money back, and that means that there is an obligation on the company to make payment. It is not equity, it is debt. A share entitled to an annual dividend of 10% of the nominal value, even if it was irredeemable, there is an obligation for making that payment if the profits are available. And because of that obligation, it is not equity, it is debt. Shares are redeemable only on the winding up or bankruptcy of the issuing company. Now, with this one, if we are saying that the entity is a going concern, it's going to carry on for the foreseeable future, well, that provision is really just giving it a higher ranking on insolvency, on winding up. And therefore, by concession, that third one, so the 21% of you went for this, very well done, that is considered to be equity. A loan convertible at the request of the holders into 1 million of ordinary share capital, because you're going to get £1 million worth of shares, a fixed monetary amount, that is not equity, because there is this obligation that that amount of value is going to have to be given to you. Now, with a lot of limited companies, you might not have any issues around this much of the time, because they might just have ordinary share capital. Occasionally, as they mature with succession planning, you might have more myriad forms of capital, but it's not common. With an LLP, the membership's relationship with the LLP as a starting point is a blank sheet of paper. They can decide how and when they want to work things. And that makes this one of the most critical issues. Are the members' interests, are the members' capital contributions, in whatever shape or form they take, should they be presented on the balance sheet as effectively liabilities, or should they be presented as equity? And as always, anything on the balance sheet, the issue is going to be around creditor protection. Are we giving the clear message to creditors where they would sit on a winding up of this LLP, on the basis that obviously if there was some kind of failure, if they had been misled, there could be some kind of claim challenge on the accounting. Okay, well done. That at least raised the issues. And if you did get 5 out of those, fantastic. I'm glad you're with us today. If not, then obviously I hope that did fill in a few gaps for you all. Now, in terms of the option to use IFRS, it isn't very common at all. I do see the kind of more larger international partnerships, law firms, accountancy firms will often use this. But essentially, as with any decision to use IFRS, it is available, but having made that decision, you can't easily go back again. So that is why I've referred to it here as a choice, but it should probably be seen as a one-off choice. Having made this decision, that's it. You're kind of stuck with it. You can go back if you stick with being an IFRS for 5 years, but to keep chopping backwards and forwards, if you lose the consistency of how you're calculating profits for your members, that could well be seen as being kind of more trouble than it's worth. Okay, so if we kind of work on the basis the majority of LLPs in whatever way, shape or form will use UKGAAP, just to go into what actual kind of specifics you do need to consider under UKGAAP. The main issues which are covered on top of your normal reporting requirements in the SORP, well, the first one is whether the member's capital should be presented as an equity contribution or a liability. And I have done some training with the person who did at one point sit on the SORP committee helping write this. And because the SORP is going to be used by some of our biggest law firms, some of our biggest private equity funds, some of our biggest accountancy firms, PwC and Deloitte and the like, there are a huge number of vested interests when it comes down to what we want to say in the SORP. And I think he's recognised that the language sometimes gets so complex and confusing, and the various illustrations they give and flow charts and checklists, you can get lost in the real mess of that. I will try and give you, by the end of this session, a hopefully relatively simple working framework to work within. It does also then treat not only what it looks like on the balance sheet, but how that then appears in the profit and loss account. And it does prescribe the formats of profit and loss account and balance sheet you should use, how the classic Companies Act formats need to be adapted and varied if it's an LLP. Now, initially when doing these sessions, one of the first questions I always get is there any good software out there? And unfortunately, for the first 2 or 3 years, the answer was probably, well, no. No one seems to have got around to it. And one of the common mistakes was that you would just run your normal accounts production software and then try and tailor it. Now, things have moved on. There are better varieties available from all the main providers who will provide options for LLPs. There are the formats in the SORP, and there's plenty of precedent examples. So even if you were just setting up a kind of Word document template, there's at least a lot more to kind of head you in the right direction, what these things look like. Converting to an LLP is covered, particularly if you were stupid, reckless, or were forced to do it in the middle of the accounting year. And then the final point is, what if the LLP is obligated to make payments to its members after they have left, after they have retired? Now, again, this was one of the kind of classic professional partnership arrangements, that when you retired from the professional partnership, any capital would be converted into a loan, which would be paid back to you in installments. And typically the partnership might give you an ongoing profit share as a form of pension. Well, as soon as you've got a post-retirement benefit, the accounting for the LLP has to be consistent with what you would normally do for a company. And therefore, that raises all of the normal issues around the form of pension that you've got. Is it defined contribution? Is it defined benefit? How does it need to be valued? Which I will come back to later. Obviously, the way the world has now evolved with pension contributions and the use of a lot of kind of work-based defined contribution schemes with payments going into SIPs or whatever, it's a lot more straightforward. There is a regular obligation for the year based on the various payments that you're entitled to in that year, and that's the end of the process. But you just need to be aware. Okay, there's a couple of other bits in this kind of setting the scene session, which is really what part one is going to be. And I just want to go through what would normally go in the annual report and then quickly run through what are the various options which are available for the different types of LLP. And then it will probably be welcome to one and all to have a very short break. And the format is the SORP does require you to obviously include financial statements, and they would be your normal UKGAAP primary statements, which is why I asked that question. Profit and loss account, other comprehensive income as a separate statement if it's significant, or combined with the P&L account if it's relatively straightforward. A cash flow statement, unless you're exempted. All the normal exemptions apply for smaller and group entities. Always, every time, a balance sheet, and always, every time, a statement of changes in equity with the various supporting notes to the accounts. There will be a statement of members' responsibility, like the director's responsibility statement. If you're of that scope, if you're being audited, if you're not a small LLP, there will be the auditor's report. And there is a suggestion in the LLP that you do include some kind of members' reports, just setting out the kind of content that would normally appear in a director's report. Now, obviously, for small entities, it is increasingly the case that directors' reports are of very, very little and diminishing use and purpose. There is hardly anything in there. Is it really worth it? And that is something the government are looking at again, with the view that all the real detail is going to come in if you're a medium-sized entity in your strategic reports, and if you're a large company in those enhanced strategic reports. But there is some guidance from the LLP SORP, what should be included as a minimum, suggesting things like what are your principal activities, any significant changes, any non-UK activity. Again, for flexibility, I know more and more businesses are now looking at operating through a branch network rather than using subsidiaries, because it just gives you flexibility. It's easy to change, relocate, close it down, open it up. You maybe don't have the same kind of legal weight to what you're doing, but there's always these gains and losses. Tell people who your members are, like you would list your directors. Make sure you've made it clear what is your policy regarding members' interests. So just spell it out to people where they sit in terms of creditor priorities. And that at least gives the message out to people. If you were an independent creditor dealing with this LLP, where would you sit? As I mentioned, medium-sized LLPs would have to include a strategic report. They are covered by that requirement with all the normal content about risks, opportunities, future potential. And if you're a large LLP, you will currently have to comply with the greenhouse gas disclosure requirements, which are set out in the streamlined carbon and energy reporting, which have been there for 5 years. And also you could possibly be required to comply with the new ESG reporting framework if you are considered to be a public interest entity. But again, those are kind of slightly side issues. This is where I think actually for a lot of owner-managed businesses, there is a suggestion here which is really sensible. How many owner-managed businesses do you think, well, don't look at the profit line, because they actually take out way more than it is normal in terms of their salary? Or don't look at the final bottom line profit, because they don't really take a salary at all. So, you know, that salary which would normally go on a mortgage application is irrelevant, because they take the money in dividends. And again, sometimes looking at the balance sheet, if they are taking out as much as possible out of the company in dividends, just to reduce their exposure to risk, because if it's sat there in the company, it is potentially exposed to creditors. That might give you a very low net asset value. That might give you a negative balance sheet. But you know the owners of the business are sat behind it and will fully support it because they're making such a good living from it. They're not just going to let it fail. And there is always that problem that with a limited company, you're battling about those preconceptions. If it's a negative balance sheet, not touching it, it's bankrupt, even though the owners are sat behind it with all the money in the world to keep it going so they can make a good living from it. Now, with the LLP SORP, it suggests that with your balance sheet, we follow the old partnership model. You rule off when you get to assets available to the members. And then under the members' interests, you effectively divide them between those interests which are in the form of equity. The LLP can decide when that is being paid back, or are they in the form of liabilities that the members can demand their money back. Now, I think that is a much more sensible presentation. If there were loans to or from shareholders who are directors, I think that would be a much better presentation. The profit and loss account, again, you stop when you get to profits available for the members. And the members' profits are then divided between what we call profits for the year, which are effectively fixed remuneration, which is kind of charged as an expense in the profit and loss account, which is what it's got to be called. And then what is left is the profit which is available for discretionary distribution to the members. So again, that would be the kind of profit and loss account where you draw the line, profits available to the owner managers. How much do they generally take as a fixed allocation, and how much is basing on how well they're doing that year? Now, that point around members' interests and where they sit with other creditors, you've also got to spell this out to people. You have got to keep on the balance sheet a separate note which makes it clear what is the total amount of the members' interest, on the basis that some members might owe the LLP money, like some directors might owe the company money. You will have some assets, you will have some liabilities, and therefore what you're required to do is show what is the total and how it is broken down between assets, those interests which are liabilities, and those equity interests. More than that, you've also, in most cases, got to explain to people where those various members' interests sit in priority with things like the other bank loans, the other creditors. Are they going to go in and grab their money first, so that any creditor dealing with that LLP cannot say that they were not warned? Okay, I am aware that before we know it, it is 10 o'clock. Hopefully that's how it feels for you as well on this Friday morning. Just going to see if there are any questions that I need to deal with at this stage. I see that there was a reminder you can put things in Q&A if you do have any questions. Nothing has come in so far, so I'll take that hopefully as a positive. I was going to suggest, as was suggested to me as well, that we take a short break here. All okay so far? Any questions? Okay, if you want to take just a short break, 10 minutes, so till 10 past 10, please feel free to do so. Grab a comfort break, tea, coffee. I'll see you back in 10 minutes. Okay, just another minute, please. And then if we can, make a start again for this second instalment. So hopefully revived, refreshed, ready to go again. We will be taking another short break somewhere around 11 o'clock, and then get into the final session, but we'll start again just shortly. In this session, we are going to be looking at certainly what is the kind of biggest single issue that you will face with every LLP when it comes to the accounting, which is dealing with the partner's interests and their profit shares. So that is why I'm dealing with it in this second session, when hopefully you've all kind of got going on this Friday morning, got in the swing of things, and can deal with that biggest topic. So we were talking about members' interest just before the brief break. I just want to just wrap up the other kind of key issues when it comes to what are your reporting requirements and obligations under UKGAAP in accordance with the SORP. Now, the next thing to note regarding the SORP, that presentation that I just mentioned in kind of outline view, what it actually looks like in practice. This is an example of a fairly sizable professional partnership. It is a fairly significant law firm. And in terms of what their profit and loss account looks like, well, this is their LLP profit and loss account. Nice, clean, simple. What is the profit which is available? Now, the fact that they're paying tax is somewhat unusual, but it could well be the case that although as the LLP, they wouldn't be paying tax, if the LLP had control of other entities like a subsidiary, it is possible that that subsidiary was making some profits, and therefore within that subsidiary, there would be corporation tax. So that would explain why there could sometimes be a tax charge if you're looking at an LLP set of accounts, but that will not be the tax on the profits of the LLP. Now, in this particular case, they are not paying any fixed profit shares to the members. Every single penny of profit is available for discretionary division amongst the members. That was the case in the most recent year and in the year before. There is an example in the note handout, which was in the chat box, which is of a two-partner LLP, and that does have remuneration charged as an expense. So there is an example of the very kind of entry-level, simple version. This is a more sizable, involved organisation. In terms of the balance sheet, again, all I'm sharing with you here is the bottom half of it, because the top half is standard. Fixed assets, current liabilities, any long-term liabilities, net assets. But it would be net assets available for the members. And then what we're clearly showing here first is that those members which are effectively debts due to the members. So this is where there is an obligation imposed on the LLP to make payment. And certain elements of the members' capital, it has been decided, are in the form of a liability. That is 17 million. Other amounts, and there would be a member's interest note, which then explains what those other amounts are. The other amounts are 33,176, and those are also obligations for payment to the members. And then what we distinguish from that is the members' other interests, which are equitable interests. And notably, what they're showing is that there is negative equity, that they have, for whatever reason, taken out way more money than has ever been earned. Now, if you presented this in a limited company, it would be credit rating wheels coming off as everyone would run a mile. But this presentation says, yeah, on balance, they've contributed 30 million. But it is this mixture of these three separate elements. It just raises the question for people to have a closer look as to what explains this breakdown between a 50,000 or 50 million, liability and a 19 million negative equity. And then what we are required to prepare is a member's interest note. So the changes in members' interest, this is your equivalent of your changes in statement of changes in equity. And that explains those headings that we just saw, the 19,884 of equity and the other liability balances, what have been the various movements in the year compared to the previous year. So this shows into the equity reserves, there is the 35 million of profit for the year being allocated. There is an adjustment to the pension scheme because there is a defined benefit pension scheme. This is a fairly old law firm, so that is not particularly surprising. And then there is reference to what are called divided profits. And the LLP SORP talks about profit division. And that is quite a useful use of language, because essentially that is not a massive step away to dividends. But what we then show is that there has been this dividend allocation, which therefore means that is now the partner's money. So that then has been divided to them, a dividend has been paid, there is this obligation to the members. And then what we show in the loans and other amounts due from members, that they've got this 36 million which has been added, the amount of drawings of 46 million, that is what has been permitted by the LLP. That is just how they decided to manage their cash flow. And therefore, it would appear, for whatever reason, they are letting them draw more money than they've earned in that year. But that is a cash flow management issue. It could be catching up from previous years, which could well be the case here, because there's those members' interests at the start, 43 million. It could possibly be, and this is where it can get more complicated, that the profits they are using to work out the profit shares do not include all the gains and losses which are included in the accounts. So, for example, the accounts might have some investment property, and you might be showing investment property gains and losses because you're required to in the accounts. But they might have decided, when it comes to the profit available to the members that they can draw, we are not going to include those property gains or losses. So that is why there can sometimes be a disconnect. Some LLPs might decide that actually they're going to actively restrict drawings because, you know, to build up some reserves in the company, in the liability partnership. And again, on the members' capital, the members' capital is classified as a liability, and we've got new capital introduced with new members joining in the year, and then capital being repaid, presumably as people leave. That is really, those are the three main specific statements that you would get in an LLP, which are unique to LLPs. And this is where we replicate that partnership approach. Now, I am going to look at a couple of other examples on this, a very, very, what I would hope is a simple example, and then also a more involved example, maybe which would more replicate what you would see. Before we get there, though, just in terms of UKGAAP, the various options, like my LLP, whatever I do, however hard I try, I never seem to be able to be breaking out of being a micro entity. My income, my asset total, I'm always a micro LLP, which means I can use FRS 105, which means I don't have to follow the SORP. Because the LLP SORP is designed for those producing true and fair counts under FRS 102, I don't have to follow the SORP. So I just have to follow FRS 105, which means profit and loss account, balance sheet, no notes to the accounts, the normal footnote disclosures, and that is it. Now, I've got the choice of using full FRS 102, FRS 102 1A. I've got the choice of using IFRS if I wanted to. But as a micro LLP, I've got that option. Now, the other advantage of FRS 105 is that the accounting requirements are not only reduced in terms of your presentation, but the disclosures and the valuation is also much reduced. Once you become a small LLP, you've at least got the option to use FRS 102 1A, and you don't have to follow the full disclosures in the SORP, but you would have to follow those disclosures, paragraphs 63 and 64, which was the detail of the members' ranking as compared with other creditors. And then obviously, as you become a medium-sized or a large LLP, you would have a full audit. It would be full FS 102, and you would have to follow the full SORP in full, like that example I was just showing. It is still the case as well that obviously when it comes to the filing requirements, you follow the filing requirements for micro, small, and medium-sized and above. Now, my earlier poll questions kind of was designed to illustrate that every time UKGAAP changes the core standards, then we do need to change the SORP. The last critical changes to UKGAAP took effect 6 years ago now, 2019, and even then they weren't of huge significance. There was the ability to keep doing what we'd always done with intangible assets regarding whether we split them between goodwill and other separable intangibles, and effectively just allowing us to carry on that if there was no clear, visible external market, we could just treat them as goodwill. Also, if investment properties were held within a group, the old group exemption we used to have of saying, well, look, if it's owned between parent and subsidiary, don't bother treating it as an investment property. That was reinstated because that was something that we found was very useful and sensible. Now, the more significant changes, as I've intimated, are from January 2026, because we will be bringing in 2 issues which are going to be of universal application. The new approach to lease accounting, which will require all material leases of more than 1 year that you are renting under existing operating lease agreements, they're going to have to come on your balance sheet as right of use assets. And that will be the net present value of the estimated remaining payments from the date of transition, which is 1 January 2026. If it's not considered a lease at that point, then effectively, you don't have to suddenly ask yourself, is this actually a lease that I've not spotted? But if it is something that has previously been considered an operating lease that you would have included in that operating lease disclosure about the commitments, then you're going to have to put it on your balance sheet. If you are a micro LLP, you will not have to apply the new lease accounting. So what this means is increasingly micro entities using FRS 105 are going to be moving further and further away from what would be the normal UKGAAP. And that is an LLP micro entity as well as a limited company. The other universal change, which is going to apply to everybody, micro, small, medium-sized, is that effectively you will now have to be applying the principles of IFRS 15 when it comes to revenue recognition, the 5-step process which is at the heart of that. And effectively, the existing approach we've had for many years, risks and rewards of ownership, is going to be replaced by when does the economic benefit pass to the customer? When does control of that benefit passes? Does it pass on a particular day or does it pass over a period of time? Now, I do know, I mean, as was mentioned at the start from Richard, I've been doing this for quite a few years now, over 30 years. And when I did my training as an accountant, we had no accounting guidance really on revenue recognition. You would recognize the revenue over time prudently, and that was pretty much it. We then decided to start bringing in accounting guidance. The first attempt was application note G. If this resonates with some of you, well, you're more like my vintage then. This was over 20 years ago. And as soon as we put guidance in place, it seemed to run counter to what everybody was doing. And all manner of accountants, law firms were up in arms saying, well, that is just ridiculous. We've never done it that way. We eventually had further guidance with UITF 40, which tried to address some of those concerns. Well, all of that has now been long ripped up and replaced. We have FRS 102, and that is fundamentally changing. I am going to look at this because for professional services firms, it is going to be something of an issue. Maybe not as much as we saw 20 years ago, but it will need to be considered. There are a few additional disclosures coming in for small companies. They will have to disclose the dividends paid and payable in the accounts. Now, one reason for this is I understand it is going to be the case that in the CT, the corporation tax CT 600 calculation, you are going to have to start listing who you've actually paid dividends to, naming names, who's got how much. So that can be tied up to the individual director's personal income tax returns, which has never been the case before. Which I know as an LLP has been the case with LLPs for many, many years. You do the LLP partnership tax return, which sets out what are the profits of the LLP for the year. And then you specify, based on the profit sharing arrangements for that year, who these profits are going to be allocated to. From memory, I seem to remember naming names and unique tax references. So that can then be tied up with what goes on your individual tax returns. So as with a limited company, what a lot of LLPs do is say to the people who are working full-time as members, we'll do your tax return. We'll deal with that. We'll make sure it does all line up. And if you want, we'll make sure that the tax is paid as well. So rather than you taking it as drawings and then trying to remember to pay it, what we will do is we will reduce your drawings for the amount of tax which is payable, and we will make sure that that is paid on the due dates. Now, you could say that this is making life easy for the LLP, for the members, one less thing to worry about, particularly if they're not accountants or they're not up to speed with that. You could just get the whole pack done by the people who do the LLP tax return. But equally, there is a real risk with an LLP. And it is the risk you often face in any business with increasing profits. If you've had a good 3 or 4 years and you've had good profits, the tax bill will come, even with the new basis period rules, it will come a bit later. If you leave it up to the individual members to pay the tax, what if they forget? What if they get into difficulty? What if they get behind? What if there is kind of legal action from HMRC, which makes them bankrupt? And what if by being bankrupt, they can no longer be an active member of the LLP? What if that jeopardizes your lease agreements? What if that then jeopardizes the LLP? And I have heard of one architects partnership who ended up going bankrupt because of that. So one mechanism you can do is effectively just say, look, we'll handle it for you. We're not even going to allow you to have the money. Okay, now that is all what is coming from January 2026. We will revisit revenue recognition in a little bit more detail in a moment. But the other thing I just want to raise is something that isn't always appreciated, and that is what you have to file at Companies House. Now, at the moment, under Companies House, you've got to file your balance sheet if you're a micro LLP. You've got to give very limited footnote disclosures. That is it. Any security over assets, and that is it. If you're a small LLP, as things currently stand, you've got to file your balance sheet. You don't have to file your profit and loss account. You don't have to file any notes relating to your profit and loss account. You do have to file notes which relate to the balance sheet. So that example I showed you earlier with all the detail of the members' interests, showing what their profit shares were that had been divided, how much they'd taken in drawings, which you could use to work out roughly how much they were all earning and how profitable the business was, obviously. If you prepare that as a note to the accounts, as is kind of suggested in the SORP, because it supports the numbers on the balance sheet, you would have to file it. If you prepare it as a primary statement, the statement of changes in equity, because that's effectively what it is, it's the changes in the members' interests, including their equity interests, then it is a primary statement and it doesn't have to be filed at Companies House. That is the view of someone who helped write the SORP, and I'm happy to follow that view because it means you could keep all of that information about profitability for the time being out of the public domain. As I mentioned earlier, under the Economic Crime and Corporate Transparency Act, there is that embedded requirement in there that concession for small entities is not going to last forever, but it is still there for the time being. That is maybe a kind of more ongoing consideration in deciding whether to be corporated or unincorporated. Okay, now what I want to do, I mean, again, hopefully you are all fully up in the swing of things, because we're going to deal with what has been the key issue in LLPs ever since day one. And it is that distinction in the profit and loss account and balance sheet. Is the interest to the member equity or liability? Is the profit share essentially a form of expense, or is it a discretionary profit share? And we've had exactly the same issues with limited companies. Again, this came in 20 odd years ago, and we embedded the new international approach to whether things should be presented as debt or equity. And as with my question earlier, this was based on that universal definition of what equity is. It is a contractual interest in the residual net assets, not necessarily a share. And that was particularly to address the abuse of people dressing up loans as share capital and hoping that no one would actually spot that these were really shares, that these were really liabilities. Now, that is the definition that has been embedded in companies law. And what this effectively means is that essentially, if you are reporting it as a liability, however much you're paying over and above the amount of liability is a finance charge, which must go through your profit and loss account as a finance charge. If it is reported as equity, any dividend distributions on equity are not reported in the profit and loss account. They're reported in your statement of changes in equity. So with the LLP SORP, they've got to effectively follow this same framework. Now, they've gone through about 4 or 5 attempts to this, and I think they finally got it about as clear as they're ever going to. I think one of the initial problems they made, or one of the initial mistakes they made, it is felt by many, is that they asked a lawyer, and they asked the lawyer what their view on this situation was. And you got a very kind of learned legal opinion, which effectively said, well, as I would agree, the old distinction between capital and current accounts is no longer valid at all, because those terms don't really resonate with UKGAAP. We can't be using that as our basis. And they did therefore pick up the fact that whatever the members have contributed in whatever shape or form should be discussed as to whether it is equity or debt. And again, following the same approach, if there is some kind of obligation imposed on the liability to make a payment, then it is debt. And anything which doesn't meet the definition of debt is equity. Now, you could say in a lot of LLPs, you could look at this and say, well, there's no real issue. You know, actually, I mean, like in mine, there are two members, all profits are shared equally, and that's it. You know, it's all their money. That is all equity. That is all equity because, you know, they're entitled to it, but it will be, you know, paid whenever they're good already, or it is all a liability to those partners because that's how they view it. But obviously, you've just got to make sure you've checked, how do these things work? Is there an obligation for making payment, or is there not? And then, having got this distinction on your balance sheet right, then you've got to ask in the profit and loss account a slightly different question. Is what you're paying the members effectively a fixed monetary amount? Now, although it's described as members' remuneration charged as an expense, if you look at what could be included here, if they're given interest on their capital, if they're given salaries, if they're given salary-like entitlements, you know, fixed kind of commissions, bonuses, if it is an amount which could be quantified in advance, if it is a kind of a pension contribution, which could be quantified in advance, we're going to be paying this amount. If it is the national insurance on the salary entitlements, which have been considered as disguised remuneration, all of that would go through as members' remuneration charged as an expense. Now, it uses the phrase automatically divided. Again, slightly confusing. What it basically means is that the decision has been made that whatever happens in the year, good or bad, you're getting this amount of money. So effectively, as I mentioned, if you could quantify it without knowing what the profits are, it's probably going to have to be reported under this heading. And then everything else, as was presented earlier, are those amounts which are available for discretionary distribution to the members. Now, the guidance around that identifies three separate elements to the conversion of those discretionary available profits to an actual balance owing to or maybe from the members. And it talks about allocation, division, and payment. And those are the kind of terms you just need to get used to. What is it talking about? Step one, although they could happen in any order, step one is the decision to divide, which is effectively how much are we now going to make available to the members. Allocation is how is it then going to be divided amongst them? Is it 50-50? Is it equal shares? Or is there some kind of different template that they use? Is it a kind of lockstep where they get a fixed increasing percentage for each year they work? Is it purely based on merit? Is it a point scoring system for that year? Whatever it is, that is going to go into the allocation. And then the cash flow is just how they've decided to make the payments. Are there regular monthly payments with an adjustment then when the year-end accounts come in? So those are the steps you've got to kind of interpret. If you've got a blank sheet of paper from the LLP, you might at the very least be very well advised to get them to set out what is their understanding of these three steps. Now, the allocation informs what then goes on their individual tax returns. The division is just converting it from potentially being equity reserves of the LLP, and it turns it into potentially being now a debt due to the members. Now, the significance of that is that effectively, if it is sat there as undistributed, undivided equity, it could well be challenged by other creditors. So you've got to be careful, because sometimes what the lawyers will do is actually kind of put in mechanisms that division is 100% all the time. Now, that's great because it does give you this kind of clarity that it is all absolutely going to be, as soon as it's earned, it is a liability to the members. And that would mean that effectively the LLP has no equity. Great for creditor protection. It might not be such a good look when it comes to the appearance to lenders and whatever. Although I think the way the balance sheet is presented, I don't think in that example we saw earlier of the law firm, there was anything there really to immediately spook a lender, because it still showed that there was that overall members' interest of 33 million, which would just raise the question, you know, how supportive are these members of this LLP? Is it profitable? Are they making good earnings from it? And therefore they're likely to support it. Okay, now what I'm going to do is just give you a couple of examples of this. The first one I'll walk through and do myself, and then the second one I'm going to give you the chance to see if you could work out what the case would be. So if we start, I'm going to do the very easy one because I'm in charge, I can. You've got two members who share profits 50-50, and all profits are automatically divided. So essentially, as we're going through the year, they're going to be making drawings on account like any owner managed would be, and it is decided that all profits are automatically divided. The profit for the year is finally agreed to be 200,000. How would that have to be reported? Now, I'm the kind of person, I was talking to someone recently who worked for a very major financial institution. Actually, it's one of our biggest banks, and I was doing some training for them, and just said, you know, the value of being able to reduce everything to debits and credits. You know, even if it's expected credit loss provisions against your mortgage loans, what are the debits and credits? So obviously the first thing which happens here is they're taking drawings during the year. Credit cash, debit, members' interests. And that would mean as you're going through the year, there would be increasing debit balances on the members' interests, which would be therefore reported as a current asset, because that is the profit. That is what they've taken already in drawings. When you get to the year and you've got the profit of 200,000 calculated, that would then be credited to the members because it is automatically divided. And therefore, member one, if they get 100,000, would have a 30,000 credit balance remaining on their account. Member two would have a 10,000 debit balance. So member one would show up bottom half of the balance sheet, showing that they've got this net balance of 30, and then member twos would be under the current asset. Now, the double entry for this is at the back of your slide, so it is there to work through, but those would just be your basic journal entries as you went through the year. And if it is automatically divided between them, if there was this obligation, it would just show up that that 30,000 is now a liability to that member. Now, just to give you an example, which is slightly more involved to have a think about, and there's another one that I'm toying with whether we look at it, but I might have to ask on that first. Can you just have a look now at this example where you've got 10 members? Each one on joining is actually required to put in some capital, unlike my example, and they've got to put in 100,000 each. Profits are allocated 10% each, but only once there's been a decision taken to give them a dividend to divide the profits. And that decision requires the resolution of all 10 members. If a member leaves, the capital can only be repaid on the passing of a resolution again of all the remaining 9 members. Otherwise, they keep the capital. You're doing the accounts, the £1 million has come in, they've made 500,000 profit, and they've taken 300,000 drawings. You could say that is 30,000 each. Can you just have a think about how this would show up in those final LLP accounts? I'll give you a minute or so to have a think about it, then I will walk you through the solutions to this. Okay, so step one, when the capital comes in this case, at least they've got some policies in place that the money will not be repaid until the LLP members, so the LLP has decided. So that effectively means that 1 million of capital would be presented as a member's equity interest. So you would debit cash, credit members' equity interests. When they're making the drawings during the year, exactly the same accounting as in my example, credit cash, debit the members' interests, and those would be recorded initially where they'd show up as asset balances because effectively they're taking money in advance. And then when we get to the end of the year, we've got this profit of 500,000, but there is no division until again the LLP decides how much of that is going to be divided. Now, we know it's going to be allocated equally, but they got to make that decision first. So what would go down in the accounts at the year end would be equity interests of the members, 500,000, because they can decide as and when they're going to allocate it and divide it to the members. Now, in the subsequent year, it's a bit like then as has happened with the final dividend. You know, again, going way, way back in the day, you always used to accrue for the final dividend in the year that it related to, even though at that point there was no obligation for payment. It's exactly the same here. The 500,000, if it is all going to be paid out as a final dividend, that decision hasn't been taken at the year end. So therefore, you would show this as an equity reserve. And then when they do take that decision, then you would, as was the example I showed you earlier, you would transfer it out of those equity reserves and you would transfer it across now as a liability to the members, divided between each member equally, 50,000 each, potentially. If they've all taken 30,000 drawings each, you'd have a 20,000 balance on each individual account. Now, if you bear with me a moment, I wanted to just show you the answers to this, so bear with me. Sorry, there's a bit of strobing here, and you've got all of this to look forward to. But essentially, for my first example, we have got those cash payments in the year, 180,000, other debts due from members, actually it would be, and then the 200,000, because it is automatically fully divided, 200,000 has been added to net assets. It would sit there in reserves, but immediately would go across to the members. So the other debts due to members would show the 30,000 credit balance and the 10,000 debit on the other. On that more involved example, we would show, as I say, the 500,000 as equity, the 300,000 shown as a debtor during the year. And then when they take the decision to divide, they would then transfer it across. Any questions on that? One question I have been asked by a separate group, what happens if the profit share is to a corporate member? How does that appear first in terms of taxation? And if it was going to a corporate member, it would then go on to their individual corporation tax return, and it would be calculated in accordance with corporation tax profit rules. So you would have to make those normal adjustments. In the company's accounts, obviously what you would then show is when there is that division, they could show income being earned from the investment in the LLP. and that is going to presumably be paid in the form of cash. They would have the initial investment, which would be part of the cost of investment. I've had a couple of questions. I was going to raise these because they've just come in now, so I'm not leaving them all to the end. How to protect the members with accounting treatment in the event of a catastrophic loss in the period? Well, again, in terms of protecting the members, there is this case, the more money they've taken out and have got into their personal accounts, it is a limited liability partnership. And therefore, this is why the lawyers would often suggest taking that balance sheet total down as low as possible, because there is no recourse to the individual members. If the whole thing goes horribly wrong, they're protected if all the money has been allocated and taken from them. And you know, other than that, I mean, and having worked for a partnership which did once suffer from a catastrophic loss, we received a huge legal claim. I'm not going to name the names of the firm. It ceased to exist after this because there was a 36 million uninsured loss. And all he effectively could do then was kind of dive for cover and try and find employment elsewhere. Just seeing another question which has come in. For a partnership, a minimum of 2 partners is required. Would the partnership structure apply for 2 partners in the below 2 scenarios where one partner takes 100% of the profit and the second one is salaried partner? Yeah, I mean, the profit sharing arrangements are not dictated by law. It is by a partnership, 2 or more people operating in business with a view to making the profit. How they decide to allocate it amongst themselves, it is up to them. For the second part of the question, I would have to look into this in a bit more detail. It said, what if you've got one natural person and the other is a limited company? Well, you have got 2 partners. So that would seem to meet the minimum requirement. I suppose my initial concern on that is just the transparency of who is behind that limited company. And that is more on the kind of money laundering, corporate transparency in actually getting to a human person behind it. But again, like with a limited company, I'm guessing if you've got one named person, at least there is a point of contact. And also, I know there is the case with the kind of ongoing changes at Companies House, actually making sure that the registered address is somewhere where you could go and visit and serve documents. And the old option of using a PO box number or something which kind of doesn't lead to any kind of clear location where you could bang on the door and see if there's anything going on there at all, that is being replaced by this requirement. You've got to have a physical presence somewhere. Okay, now apologies for strobing forward. I just wanted to put those up on screen with you. The third example is quite niche. I included it in the notes because this is an issue that I'm just going to strobe back. So just leave that to one side for a moment. The latest version of the LLP SORP did increase the guidance on this point. And it's saying about what if there is a fixed profit share to someone who doesn't provide any services at all to the LLP. So they're not working for them. Now, the reason they've raised this, because it is not uncommon in the more kind of private equity fund, investment fund models, that you will get those people who are just the kind of regular investors and they will not do any work. And the money that they've put in would normally be considered to be a liability, because there is normally the mechanism that they will be paid back on the kind of completion of the project. And often there would be that they do get some kind of regular profit share. The equivalent we see in limited companies is that they would get a fixed dividend on their share capital. So the question has been raised, if they put in £1 million though to an LLP and they're going to get 200,000 a year, and they're entitled to take cash a year of 150,000. How should that member's capital be presented? Because the question was, we seem to just presume that we present it as 1 million. But if it is going to be repaid in 5 years' time, then it is actually a long-term liability which should be reported at amortized cost. And therefore, what we would have to do is discount it to its net present value and each year show what is the increasing value because of that kind of finance element which is imputed within it. And the difference would be a kind of initial kind of equity contribution to an extent. If the profit share entitled you to an element of overall profit of the LLP, so there was a kind of equity sharing mechanism within it, then it could be that it is going to actually have a market fair value, which would require you to revalue it each year to fair value. So this is the kind of level we've now got to with LLPs, with the kind of more involved, sophisticated funds asking for those kind of more involved questions. Do we account for it at just the original cash? Do we account for it as amortized cost? Do we account for it at fair value? And again, not surprisingly, the answer from the LLP SORP is it depends on the nature of the arrangement. What is going to be paid? Is it going to be that monetary amount? Is it going to be variable by profit? And the cash going through in the year, the automatic share of profits, those are just the kind of basic mechanics to be reported. Now, I will obviously see if there's any other questions on profit sharing arrangements later. Obviously, when calculating the profits for tax purposes, if it is not considered to be a taxable profit, then when you're doing the partnership, the LLP tax return, you would adjust the LLP profits for those non-taxable profits. But that is the normal kind of income tax adjustments on this. If the person is receiving a profit share, if it's an individual, it would be taxed like normal income tax. Okay, I'm just going to introduce one final issue, which is probably less of an issue than it used to be historically. And then I'm going to suggest we take the final brief break, respite to you for gathering your strength for the final session. It's spoken about in the SORP in terms of partners' annuities, but effectively what it's talking about is a post-retirement benefit payment, an obligation to make payment to people who no longer work for you. Now, the first thing to appreciate here, the third point on this slide, is if there is no obligation for any such payment in the accounts of the LLP, if this is just something that the individual members have agreed amongst themselves. So if in my example with the 10 members, if they said, yeah, if one of you leaves, the 9 of us remaining will pay you an ongoing income, then you don't have to worry at all about what goes in the LLP accounts. If it is an agreement between the LLP and the individual, well, then there is guidance on how this appears in the profit and loss account and how it appears on the balance sheet. Now, the first thing they've got to recognize is that this is essentially like any other pension. You've got to ask yourself, has the LLP got an obligation that has not been paid in full? If they've got a very simple kind of work-based scheme, making regular contributions, which is every payment is made, completely fills their obligation, you would record that payment through P&L, probably as a member's remuneration charged as an expense, end of story. If there is an unpaid obligation at the end of the year, if it is a relatively simple fixed amount, you know, they haven't paid the last month's contribution into the pension fund, That's what goes on your balance sheet. It might have to be discounted. Then it gets more complicated. If it is variable to any extent, what is that variation based on? Is it based on the profits of the LLP? Is it based on the life expectancy of the individual receiving it? If it is like a defined benefit for the rest of their life, if it is like an annuity, as is suggested in the title. And then it would suggest you either use the guidance that normally applies to provisions or contingencies, if it is really just an estimate. If it is life dependent, you would use FRS 103 because it is essentially an insurance policy. If it is dependent on them providing service over a period of time, that they build up their profit share over time, then you build it up over time, like adding benefits to a defined benefit pension. The final complication that I'm not going to stray into because it's already 11 o'clock and this opens up a whole extra wormhole of complications. If they've done something like made the profit share effectively some of the shares, if the LLP was incorporated, then you have got a share-based payment and you would have to follow the guidance on share-based payments. I'm going to leave that part there as a further complication. That might be what is seen as the really good exit route, where you transfer your members' interest into shares so you don't have a cash gain and you don't pay any immediate tax. Yes, it might be good for tax, it might be good for delaying, deferring the tax, but it could give rise to a big accounting issue. You've got this share-based payment. In terms of the presentation, if they've retired, it's a liability and it is a normal operating expense. If they are current members, it would go under members' interests as a separate, normally line item of the members' interests, a liability, and it would be charged as members' remuneration, charged as an expense. So to take us to the break, one final example, if a former member is entitled to 10% of profits post-retirement, I can't quite read the end of this box here because of where the slides are. Let me see if I can get it up in front of me, until their death, then that is obviously life dependent and you would have to apply normal insurance accounting towards this, which would basically be, if it was significant, some kind of actuarial valuation. If it is 100,000 a year fixed for 5 years, then what you would do is apply just normal accounting treatment for a financial liability. It's a formal member and it would be that, again, discounted for the interest rate. If it is 1% of profits for 5 years, it is a more complex financial instrument. And effectively, you would have to consider what is your best estimate of profits. All of those would go down as liabilities with an amount going through as an operating charge for the difference in the liability from 1 year to the next. And then finally, if it is a member who is entitled to an annuity after 5 years, but they've only worked for 3 years, then you would apply normal provision accounting. To what extent do you think they will make the 5 years and will be entitled to it? And therefore, if you felt that this was more than 50% likely, you would estimate what that liability is going to be. And essentially, that would then be included as part of the members' interests as a liability, and it would go through as members' remuneration, charged as an expense. Okay, I'm going to let you to stop, pause, and think if you have any other questions around that, because I'm going to suggest we take the final short break just till about 10 past, if you can do just a quick 5 or 6 minutes. And then what we're going to look at first is definitely the next big topic. And it's one Richard kind of intimated, revenue recognition, and then just a few other issues to consider to take us through to the close. Okay, have a final break. See you back soon. I'm going to mute myself down. I'm going to turn off my video and I'll see you back in 5 minutes or so. Okay, 1 minute warning, and then we'll be making a start again for your final session. Okay, welcome back for your final instalment. So hopefully you've got the stamina for the last 50 minutes or so, where we will be looking at hopefully some of the kind of more commonly recurring issues and not too many kind of absolutely niche points. Just a couple other questions which came in. I'll deal with these now before we start off again. One of them was around that change that I intimated within FS 102, and the fact that from 1 January 2026, we are going to be seeing those on balance sheet leased assets called right of use assets with the matching liability. And the question was, do you expect to see more of a movement towards FRS 105? I know a number of people currently are quite skeptical as to the benefits of using FS 105, because there is this sense it's very simple, it's very straightforward. There are no notes to the accounts. You don't have to deal with complications like revaluations, revaluation reserves. It really is just depreciation, accruals, prepayments. You don't even have to worry about deferred tax. So there is this sense that it's so far removed from what true and fair accounts should look like. Is it really worth it? Well, I'd have thought now for client service, the question should be, is it really worth it to your client going through all of that rigmarole for the new lease accounting, for the sake of what benefit? So yes, I am certainly getting the feedback from a lot of people I speak to that FRS 105, if possible, is being seen as a more attractive option, especially as the limits are increasing again. As from 6th of April this year, accounting period starting on or after, we will be looking at the turnover limit for a micro entity increasing to £1 million turnover a year. The total number of employees is going to stick at 10, and the asset total will be going up to 500,000. So it is likely that a lot of small companies might now qualify as micro entities in time for that change in 2026. The other question was, could a legal charge be put in place over the member's capital treated as debt? So effectively, if the member was an individual, could they offer that as security against some kind of debt? If it was a corporate member, could they offer that asset as some kind of security? And I guess, the same as shares in a private company, same as a kind of loan that you've made to a private company, there is no reason why that couldn't be considered for security. What the lender's view on that would be is maybe a separate matter, but not that I can see. Now, the other big issue, this goes back to the kind of FS 102 changes, was around revenue recognition. And as I kind of alluded to earlier, this has been a problem area under UKGAAP for many years, because it seems to be, even if when we go through the guidance, everybody says, yep, I get it, I understand it, I understand what the principle is here. When it gets to the reality of actually applying this in practice, somehow that knowledge, that certainty just disappears, and people either don't pick up the issues, they don't even think about them. And this is a situation where you could be getting this wrong and you would not know. The accounts could add up, the accounts could balance, but it is something that you might only realize was a questionable accounting treatment if there was a question. And that might come from HMRC, it might come from a creditor in some shape or form. I picked up a case recently I was talking to someone about, and it was on an earn-out agreement. And the earn-out agreement was based on profits in a certain year. And they had nailed down in enough detail what the revenue recognition policy was going to be. So there was then a big dispute. I thought it should be done this way. Well, we've always done it this way. So just to ease you into this, I have got another set of poll questions for you, only 3 this time, just to see where you are on revenue recognition. So if you could be so kind as to share the final 3 with you all. Again, we'll keep things secret initially, so you make your pick without being able to see what everybody else is doing. Then we will share the results with you. So when should a residential conveyancing lawyer recognise revenue? Should it be when they record the WIP? Should it be when the client is billed? Should it be when the bill is paid? Or should it be until completion, whenever that happens to be? How should revenue be valued? Should it be valued at the invoiced amount, the fair value, cost less the provision for bad and doubtful debts, at the net present value of future expected cash flows? And then finally, when should contingent revenue be recognised? If, again, maybe some kind of law firm and it's doing work on a no-win, no-fee basis. Should it be only when the contingency is completely resolved, or should it be as fair value as and when the performance obligation is satisfied? Give you just a few moments more to think about those 3, and then let's see where we are on these. Okay, hopefully you've had to think about this. So again, if we could share the results, please. So we've got a real spread for the first one. When should the residential conveyancing lawyer recognise revenue? Should it be when their WIP is recorded? Should it be on billing? Should it be when the bill is paid? On completion? The correct answer should be under the existing and even under the kind of planned guidance. It's as and when you perform your contractual obligations for that client. And if your contractual obligation is to provide legal services related to the conveyancing, which should allow successful completion of the sale, then as every unit of work in progress is recorded, that should be considered the revenue of the firm. Now, when you get to your year end, if it has been billed, you will have cancelled the work in progress. You'd have issued a bill and that will have been recorded in P&L. So you've recorded the revenue. And obviously when the bill is paid, it gets converted from a debtor into cash. But if when you get to the end of the year, you have got unbilled work in progress, then that is considered to be valuable work done by the firm, and it should be included as accrued income. Credit P&L, debit balance sheet, and it is most likely going to be taxable income. So the answer to that one, 33% of you got it. So that was in second place, only just. It's when the WIP is recorded. For the second one, how should revenue be valued? And again, on this one, I'm pleased to say the majority decision, 37%, is at fair value. Now, you could say that that is, often going to be the net present value of the future expected cash flow. You should maybe get to roughly the same answer on that, because that is what someone is willing to pay in an arm's length transaction between willing buyer, willing seller. What it does mean necessarily is the number given on the invoice may not be the fair value for that revenue. Now, I try and keep my work and my invoices simple. One invoice, one line, this is the work I did, and that is what I would expect to be paid. However, if the invoice allocates different types of service, even if it was kind of accountancy, business advice, audit, you would have to consider what is the fair value of each of those on a standalone basis, and you would only recognize them when that element of the service was delivered. Now, the third option here, at cost less the provision for bad and doubtful debts, I mean, obviously, having put a value on the revenue, and if it is unbilled work in progress, this goes right back to what Richard was saying at the start. That is just a judgment call. It can never be any better than a judgment call. If it is unbilled work, how much of it do you think is recoverable? At what value? What is our normal recovery rate? What is our write-off level we would expect? If it is fixed fee work, roughly how much of the fee do we consider that we've earned at the year end? All of those are judgments. And essentially, there is this view, you can't get it right or wrong. All you can try and do is apply that judgment fairly. Now, what I've sometimes seen in certain kind of situations, it is that effectively what you might do is just agree a policy and say, okay, well, our average recovery rate for that department is 75%. So for unbilled work, being prudent, we're going to estimate it at 60%, just to allow a little bit of margin for maybe, there might be some further overruns to come. If you make that clear and obvious, it can't really be challenged. Now, there is one other issue, which is relating to bad and doubtful debts. Yes, you would have to ask the question, do we think we're going to have to be paid, to put a value on what finally goes on the balance sheet? And again, I've seen in certain business purchases, they decide that the policy is going to be, if it's unpaid after 90 days, it is considered a bad debt. No ifs, no buts. That's our policy. If there is the probability that you might not get paid when you initially do the work, if you're doing work for someone who you think this is just a bad debt waiting to happen, you shouldn't record any revenue at all. Now, this is a point that is sometimes missed. Even though you might have issued invoices, if you think, look, I'm doing work for this business, they're clearly on their last legs. They might survive. It's a favor, or it's basically marketing, a loss leader. We're trying to get into that market. If we can help them turn things around, great. But if not, we're not going to get paid. That is something that you might decide to do. But if you are doing it, you issue the invoices, you do the work, you don't record any revenue. Now, the third one, I had a question on this just the other week from someone, and they said, look, I've got these accounts here. They've been audited by Ernst & Young, and they're saying quite clearly that they are only going to accept revenue when the contingency is resolved. That is their accounting policy. And they said to me, is that right? And my response to that was, well, it could be. As an accounting policy, there is actually no right or wrong anymore. But you've got to ask yourself, is that a reasonable estimate of the amount of revenue earned in the period if you're not putting a single penny of value on any revenue which is contingent and is still contingent at the year end? Now, going way back, that used to be UKGAAP, but that has long been replaced by the fact you've got to put a fair value on your revenue. If the revenue is contingent, you've also got to ask yourself, is it highly probable, more than 70, 80% probable, that I've not significantly overvalued this? So yes, you've got to be cautious. Yes, you've got to be prudent. But that certainly doesn't mean you always set a value at zero. And therefore, it should be at fair value as and when the performance is obligated. 58% if you went for that, fantastic. It does mean it's a judgment call. If you say, we're going to wait till it's resolved because that reflects the reality. That could be right. But if you won 99% of the cases you took on, that policy could be challenged. And I could see lenders saying, or HMRC saying, no, you're deliberately undervaluing your revenue. Okay, now those were just a few issues around revenue recognition. So again, thank you for having a go at those. Those are the last few kind of questions I'm going to get you to work through. We were looking at that before the break. So with revenue recognition, the main issue is as well, when we go into the new version of FRS 102, micro and small LLPs, you will be applying that new approach to revenue based on performance obligations. And I think that is the ideal time just to stop and check again. Is there anything that we're doing here that could potentially be challenged, could be a point of dispute at some later date? Now, the other issues I just want to raise with you in this final 20 minutes or so, and then I will see if there's any other questions that I can usefully help with. A few have come in, so we'll have a look at them. But these are all kind of variations on a theme. If the LLP is losing money, again, all the guidance leads you to in terms of the accounting is whether those accumulated losses, whether that debit balance is actually recoverable from the members. And if it is amount due from the members, it would have to be presented essentially as an asset, if that's how they've set it up. Or if certain members have agreed, we will cover all the losses. You know, for this development, we're developing this new office block. Any losses incurred during the development, we're going to cover them. Well, then that means that there is that asset due from the members. If not, potentially you are going to have this, as you would have in a limited company, a negative equity reserve. Obviously, the other concerns around this, one, does it make them a viable going concern? As always, you'd have to look at the full, complete picture, not only looking at what's going to happen over the next 12 months, but actually looking, does the business model seem like they are going to survive and get through this? I'm always in two minds with owner-managed businesses on the basis, on the one hand, they often get a really, really rough time of things when it comes to borrowing money, because you never seem to get any credit for the fact that the owners are running the business, and they often do see it as like a member of the family, their baby. They and them are one and the same thing. It's been their life's work. It's what they do, and they will support it to the bitter end. And I don't think that is often given credit. But equally, I can understand why, because often those same people can be hopelessly deluded entrepreneurs who will not even recognize the trouble they're in often. So obviously it's just finding that balance, and obviously seeing if they have reached a point where they should stop digging, they should stop bailing the business out, they should cut it loose, then obviously that's what you should do. The other issue as well, which gets more complicated, is if it's an individual who's making a loss, it is subject to the normal loss rules under income tax. So it's not generally deductible from all your other income. It is the normal rules about carrying it forward against future trading losses, potentially the ability to carry it back, different rules on cessation, winding up of trade, exactly the same as would normally apply. If it is a corporate member who is exposed to those losses, then again, they have the similar kind of corporation tax loss allocation rules carry forward, potentially carried back in certain situations. I will ask this question, just see if any of you will give me just a quick yes or no on this. Do any of you act for private equity LLPs? I know there's 130 of you around the place. Okay, well, I'm not going to dwell on this too much unless any of you say yes. I've only added it into the slides because I did have in a few groups people saying, oh, I deal with private equity. how does all this work for a private equity firm? And they were getting very nervous because obviously this is a very big, sophisticated industry. In essence, if it is a private equity structure, you would typically have, I'll just give you 2 minutes on this, no more promise. You would normally have the structure where the LLP is formed to buy the portfolio companies that they're going to invest in. These could be public companies, they could be private companies. The people running the private equity scheme will be called the general partners. And then the money comes from those people who are the high net worth individuals who are called the limited partners. The people who were previously running the company are often referred to as the founder partners, and they might be given a chunk because obviously the plan is that you get the company modernized, you get it up a level, and then you exit within about 5 years, which is what happened a few years back with Dr. Martens. The old family-run company, Dr. Martens, was bought by a private equity fund who kind of repositioned it, refocused it, brought in new product lines, new jazzy shops, and then they sold it again. Now, in terms of the accounting, the actual question which was asked all the time is, if those companies are going up in value, so I think they bought Dr. Martens for about 800 million, and when they sold it, it was worth 4 billion. So they made a 3.2 billion gain. And the question was, what do we do about that gain, which is called the carry, the carried interest? Well, in pure accounting terms, if you're buying those investments, if they're property or shares, if they are investments, you value them each year at fair value. The gains and losses would be recorded in P&L because they're investments, and therefore that would be allocated amongst the members. As it is an unrealized capital gain, it wouldn't give rise to any immediate taxable charge. So you would then adjust those profits in their individual tax returns. But you would allocate it to the members. So effectively, in however they're going to allocate that interest, there would be this additional credit to their profit shares, either credit a liability or credit to equity. That is probably enough. Now, there are a couple of examples on this in your notes that I briefly want to mention, because there is an issue here that, again, someone who helped write the SORP said, don't bother with that. It is overly complicated. Now, the general principles, if an existing business divides to convert into an LLP, now this was maybe more of a kind of one-off issue when these things were first introduced, because obviously what we did see initially was a lot of partnerships, lawyers, accountants, and professional services firms flipped from the old partnership model, grabbed the protection of limited liability, and became LLPs. Because an existing business with an ownership group were converting to this new business model, that was considered, and the guidance in the SORP is that is a merger. So you follow merger accounting. Now, luckily, even though this is not something which is mentioned at all under IFRS, we do have guidance on how to do a merger in FRS 102. And the key elements to that is that all the assets and liabilities are just transferred across at book value. Nothing needs to be revalued. No new assets need to be recognized, like goodwill and other intangibles. Now, obviously, if you were buying it as a separate purchase, then that would have to be done at fair value. But if it is just a continuation in a new legal form, transfer all the balances across to your new LLP accounting system and carry on. When it comes to publishing the accounts under the SORP, effectively you present the balance sheet with comparatives of the old partnership as if they've always carried on that business line. In the profit and loss account, you would show comparatives as if they've always been operating as an LLP. Now, there is an example in the notes which shows what this looks like, but essentially that is your normal merger accounting. You would need to make sure that obviously the old partnership accounts are reformatted so that they're in a consistent format to the LLP SORP. And there's a couple of other issues around this, which I'll raise in a moment. I mentioned, though, that one problem could be that for whatever reason, they decide that they're going to do this midway through their financial year. Now, that creates a problem, because if you've, say, got a December year end and you start the year January as a partnership, and then on the 1st of July, you convert into an LLP. Great, it's a merger, slide it all across, and you would present at the end of the year your profit and loss account for the year as if you were always an LLP, with comparatives, with the balance sheet as if you were always an LLP. Well, the balance sheet is what they would be expecting at Companies House, because it's your balance sheet at 31st December. The profit and loss account, however, the 12-month profit and loss account is for a mixture of the LLP and the old partnership. The LLP only existed for 6 months. So therefore, there is the question, we've got to show that 6-month, what I've described here as the statutory profit and loss account, but we've also got to show the full business profit and loss account. Now, what it recommends is 2 approaches that you could take. One of them is that you have a 3-column P&L account: LLP profits, statutory LLP profits, business profits, partnership profits before, total for the year. Or maybe you just show the statutory P&L as a separate statement. Now, the comment which came from one of the authors was, is this really worth it? Is it actually worth just, not complying with the SORP and preparing the accounts for the partnership to the 30th of June, and then just starting, here's your LLP accounts for the next 6 months? It is, I would say, probably more driven by knowing your client. What will be the information which is of most use and help to them? Maybe part of me would think just do a separate statutory P&L account. Although I think my concern would be, if I sent that off to Companies House, what would they make of it? Would someone there kind of pick up, get confused and start kind of rejecting and causing problems? Now, just the last couple of issues just to raise, and then I will see if there's any other final thoughts, comments, or questions from any of you, and just check through if anything's come through. If you do convert mid-year, so if you are converting across and you're moving those balances across, if it is going from a partnership, then essentially you've got to consider whether the accounting policies being used by the partnership were anything close or related to what we would normally do under UKGAAP. Now, it might be that the partnership have long decided that they're going to be using full UKGAAP because the partners all want true and fair accounts. And certainly, that was often one of my recommendations. If you want a good starting rule book where you're not starting with a complete blank page, do true and fair accounting. But essentially, there could be areas where they decided to keep things more simple, like with things like the pension arrangements. We don't want to get involved with having actuaries and all of that. Well, now you would have to. Maybe for things like provisions, they came up with, an approach for dealing with their bad and doubtful debts. And as long as it kind of stood up with HMRC, they were happy with it. Well, you might now have to think a bit more closely about it, and also how you've been presenting the various transactions with the partners. As with any change in approach, there would normally be this expectation that you would do some kind of reconciliation. So what you do is you clearly steer through everybody in terms of what were the existing balances under the old partnership accounting and what is the new balance under the LLP. The issues just to be careful of here, I'll take the final point first. LLPs do not have to account for tax, so you don't have to account for deferred tax. But what it's kind of suggesting here is if there are big differences which are going to emerge in the quantification of profit shares, could that mean that there is going to be an additional tax charge which is going to be applied to the individual partners, the individual members, and therefore we might have to consider about how we allocate that tax charge. You know, particularly if it was maybe things like, I don't know, I mean, the partnership that I trained with, this 6-partner firm, they owned the freehold. Now, by the time I'd left, there were only 5 partners, 3 of the originals and 2 new partners. The 3 originals owned a share of the freehold. The 2 new ones didn't. So you would have, if suddenly you're moving to a new accounting standard and that freehold is going to be valued at fair value, you've got potentially these very big gains which are applicable to certain members and not to others. So that is just an illustration of just some of the issues. If you do get additional gains and losses, there is the question, you know, how is this going to be treated in the members' interests? Has it been divided yet? Because, you know, you weren't even maybe looking at it that way at the time because the profit wasn't even recognised. I've made the point here, ensure the partners understand what the differences represent. I do a lot of training, not only with accountants, with the kind of updates, developments, but also with lawyers. And I do appreciate that sometimes explaining things to them like amortized cost, net present value adjustments, you've got to kind of tread very carefully because those are just not concepts. The numbers are maybe not concepts that come readily to everybody. You know, that's a bit of a broad generalization, I do realize, but you've got to be careful. So again, I think especially with where we're moving with the new lease accounting, and we are going to be recording leases at the net present value of the expected future payments, then obviously explaining what that means to the partners as we go through transition will be significant. Okay, now other than that, that is all that I would normally look to cover on this session. And as I think I planned from the start, I wanted to give a bit of time in case there are any other questions to just look at before we kind of fully wrap things up. I did get a few questions in advance. Some of them were quite specific. I will comment on one of them particularly. But I think others I might have to kind of come back to. So we've got, there could a legal charge be put in place over members' capital treated as debt to protect the balance in insolvency of the LLP. Again, I think if we're looking at it from an insolvency perspective, I'm guessing, could the members impose some kind of floating charge is the essence of the question here. Could they put some kind of charge in place over the assets of the LLP to give them priority if there was a winding up on insolvency, so they grab their share first? I can't see any reason why that wouldn't be possible legally. As far as the accounting is concerned, what you are required to do, obviously, is just make all of that in note 63 of the LLP SORP, make all of those kind of rankings and security transparent. So it's a bit like if you have preference shares, just making it absolutely clear where they rank on a winding up, what kind of protections are they. if only just to get above other people in the list of what is available. So again, I can't see any reason why not from that one. Another question we've had here: are there rules preventing LLPs from distributing profits akin to distributable reserves for companies to protect creditors of the LLPs? Not really, no, because although it's referred to as being divided, it is not actually anything where you're required, before making that decision, that you've got to do the kind of checks on insolvency, whether you've got the cash flow to warrant it. And again, I guess there is always the kind of the case that if you were taking out all the profits because they're yours, I guess that is one reason why, when dealing with any owner managed business, and there is that potential, that lenders will often look for additional security, because they know that there's very little protection in them taking all of the money out and then leaving others to suffer. Isn't it one of the, if you're insolvency practitioners, you would know maybe better than me, but one of those red flags for an impending bankruptcy or insolvency is the kind of directors getting themselves new cars or whatever, or clearing any loan accounts in their names, preparing for the worst. So not as such, not that I'm aware of, in answer to the question, are there any rules preventing them from distributing, other than the fact, obviously, if they haven't made that transparent in the notes to the accounts that that is the amount that they've allocated, then again, there could be the kind of suggestion around the reporting, but not that I'm aware of. When calculating SDLT, not my area of expertise on this one, so I might have to duck the detail. HMRC comes up with an MPV. Is that MPV what we will see in the accounts? Actually, I did actually see this, saying that it's not an area of my expertise. I did see a situation where someone had ownership of a block of flats, which they wanted to divide down into 2 or 3 different sections. And they did have to agree a valuation on that split with HMRC. The split valuation for HMRC does not have to appear in the accounts. If you're recording the assets at book value, which is perfectly permitted, then you do not have to ever revalue to fair value. If you've got a property lease, the property lease will have to be valued from the accounts at the net present value of all of the future payments discounted, but that might not sit anywhere near what HMRC would be thinking about it. So my initial response on that would be not necessarily, because that is what I've seen in the past. And equally, if the assets were being transferred over as part of a kind of merger, you would carry on reporting them at cost or fair value. What the HMRC use for their net present value is down to the tax guidance, the tax rules they follow. And again, obviously, if there is a difference in what they're thinking, that would potentially leave rise to things like deferred tax, but definitely not in the reporting. Obviously, Richard mentioned earlier about inheritance tax, which I think is your next session coming up. And I'm in Manchester at the moment and came up last night for the football. And obviously on the drive up, there were the various farmers' fields with the kind of protests up about inheritance tax. And I've seen the arguments about, a farmer might only be making, I think this was on one TV programme, a farmer might only be making £50,000 a year profit. But if they're given an HMRC valuation of 5 million for inheritance tax, they could end up with a £1 million tax bill. And that's how it was kind of left hanging. And I guess my response would be to that, again, from an accounting, if you take away the inheritance tax concession, why on earth would people pay £5 million for an asset which is only generating £50,000 a year? I'd have thought at most it's only worth £500,000. So I'd have thought any kind of HMRC valuation based on what it could have been worth with the IHT exemption should be challenged. And you should challenge for valuation based on its current profitability as agricultural land, which take it down to 500,000, no inheritance tax. That was my response on things. The other question I got was what happens if members transfer interest between each other. So it could be this kind of classic, you've got someone who's got a 40% interest, they go down to 20 and someone else goes up by 20. Again, in terms of what the impact of that would be, obviously from the LLP itself, there is no real change. It just means from that point forward, one of those people will be taking 20% less of the profits and one person will be getting 20% more. If that effectively also transfers 20% of the accumulated gains on the asset, then whatever is the fair value of the asset at that point would be considered to be disposed 20% of by one member and acquired by the other. Now, that could potentially, on their individual circumstances, trigger a tax charge in the individual who is transferring part of their share, reducing it down by 20%. But the gain would depend on their circumstances, would depend on their reliefs, and it would also depend on what is the reported book value of the asset when it is being transferred. So how much of that has already been recorded? So I did get a question around that about how we can rebalance without causing, you know, a huge tax trigger. I haven't looked at that in any great detail because, I mean, to be honest, my main expertise is around, I'd like to think, is around financial reporting. And I do often just defer the more sophisticated tax issues to people who deal with this all the time. But certainly that would seem to be the initial thinking, that there could be an immediate tax charge based on the gain in what you disposed, but that would be taking the proceeds as the market value, and the cost, even if you put no money in initially, could be based on the book value of the recorded assets. Okay, just see if anything else has come in. There is nothing in the Q&A box. Just see if we've got anything else that has appeared. Okay, now other than that, I will obviously stick around if there are any other questions. If you feel that has at least tried to at least put you in the picture with how these things work and what the various issues are, I will now call things to a close. Very great thanks to K3 Hub for inviting me to present this session to you, and for setting it up, and for helping in the background with bringing the polls up and providing the answers to that. But as I mentioned, I will stick around. We're just coming up to 12 o'clock, but I will stick around if you do have any other thoughts, comments or questions. But otherwise, thanks very much for joining us. Have a lovely rest of your Friday, and hopefully see you again at some point again in the future. Thank you.